Welcome to Oregon Cash Flow Pro. My name is James Barber, and you know by now, I'm always here to help you maximize your cash flow. We're going to look at a pretty bad IUL policy today. It's going to absolutely reinforce how design is critical. You often hear across the YouTube channels that you got to make sure you get a specially designed high cash value policy if your goal is cash growth inside of these life insurance policies. It's really easy to basically stumble across any life insurance agent in the country and get sold a terrible policy for cash growth purposes. Generally, most agents are there to sell life insurance. That's what they're taught how to do, is to sell life insurance. They're not necessarily looking to provide the best type of cash growth financial instrument that they can provide you. And there's a lot of expenses, there's a lot of costs inside of a life insurance policy if the goal is to actually just buy life insurance. Life insurance has a lot of different expenses. Some of them are inexpensive, some of them are very expensive. But in general, if our goal is cash growth, what we're going to try to do is minimize the life insurance costs and the commissions associated with it. So what we ultimately want, if our goal is cash growth, we want to minimize the expenses inside of the policy as much as possible while still maintaining whatever death benefit is that we actually want or need. Now, just a few weeks ago, I released an update on my personal IUL policies, some of them, and the performance that they're doing. So I'm going to recap that really quick so that you can see it, because this policy that is not good, that is not a good design, is from the same carrier, and the product has seen almost the exact same performance as mine. But there's wildly different outcomes. And this policy is actually a few years older as well, with a lot more money that was put into it. So let's take a look. I'm going to show you my policy, where it's at, and then we're going to look at the comparison policy and see just how big of a difference the design makes when it comes to growing our cash value with these products. Here we go. We're going to start with my policy. This is what it looked like in my video. You can see I've got $31,773 in accumulated value. Now I do have a loan outstanding. So the surrender value is only $6,000, but that's not because of surrender charges. My actual surrender charge is like $600. And we're 5 years into this policy. You can see my death benefit, not very much, $170,000. In the scheme of things, it's not very much. My cost of insurance is actually pretty low because of that. And you can see here, since my inception date in 2018, the average return, 6.62%. And the total returned that I've earned in interest, just over $5,000. Now, we're at $30,000 in accumulated value. I didn't have $30,000 every year in the policy, right? So this is the cumulative totals here, total interest earned, and this is the average credit for each year. Okay, total. So here we can see we've got my planned premium listed over there, and then right here, total premium paid. Total premium paid, $30,355. So I've passed my break even. We're in 5 years. Even accounting for the surrender charge, I've passed my break even. I've got over $31,000 in it, and I've paid in just over $30,000. That's a pretty good policy. I'm pretty happy with my policy. I passed the break even actually in about year 3. And in year 4, it wasn't a good year in the stock market. So I didn't hardly get any credit. And then we did get some credit last year. So in the first 3 years, I actually was averaging right around 9%. And then we didn't get much of anything in the 4th year. And then in the 5th year, we did get something. So it did bring our average down, right? But overall, this is a pretty good policy. Like I'm pretty happy about still putting money into this policy. Let's take a look at the bad one. This hurts to show this. It hurt for me to see it. So here we have the bad one. You can see $33,000 in accumulated value, $22,000 in surrender value. There are no loans outstanding on this. There's $11,000 in surrender charges still, or just under $11,000, just over $10,000 in surrender charges. And look at the start date. You can see the start date was 2015, and the performance almost exactly the same as mine, actually 0.01% higher, 6.63%. and this has earned $12,000 in interest. Well, let's take a look and see how much money did they actually put into this policy since 2015. And look at this death benefit. The death benefit, quite a bit more death benefit. Okay, so moving down here, look at that total premium paid, $97,870 right here. $97,870 total premium paid. So remember on my policy, I paid in $30,000, just over $30,000, and my value was $31,000. This person has paid in $97,000 over the course of 8 years, and their value, $33,046. They put in $97,000. They had the same returns. They had the same returns as me, and the interest that they've earned is just over twice as much interest earned. So this isn't the problem. The return isn't the problem. It has not been the problem. The problem is the expenses inside of this policy. They're paying for a lot more death benefit. They still have surrender charges, so it's not like they can just get out of this thing and get their money back. Because of the $90,000 they put in there, they've only got $30,000 in actual accumulated value. And if they wanted to actually quit this thing, they're going to walk away with $22,000. Now the owners of this policy are not very happy with this policy. This is not what they expected. Had this policy been designed properly, meaning with a lower death benefit and a proper blend to reduce the commissions, we would expect something similar to my policy. If they've paid in $90,000, they should be well over $90,000. It should have passed the break even by year 5. And now here by year 8, the actual value should be over $100,000. So this is a swing of well over $70,000 from where it should be if this was a proper design policy. And this is only over 8 years. I really hated to see this type of design and the disappointment in my client's eyes at this. And this was not a policy that I sold, obviously. Now, we know that the performance has worked out since inception. We like to illustrate the illustrations right now at 6%. That's where I like to do it. I tend to view it as a little bit conservative. Like I think we can beat it. And the illustrations that we design, as long as it's a proper design with the lowest expenses, they work really, really well at a 6% return, even after 3, 4, 5, 6 years. It's possible that this policy could still do okay 30 years down the road if we're still getting above a 6% average. This policy can still do just fine. But the problem is, when you've paid in $90,000 over 8 years and you got $30,000 cash value, how excited are you going to be to continue funding that policy? This is one of the biggest problems with these types of policies and these types of designs. People are getting sold these designs and being told to ignore the early years, look 30 years down the road. Doesn't that look nice? Doesn't that look pretty? And it's a nice and safe place to grow your money. But the expenses are so much in the early years. They might buy that policy, they might fund it for a few years, but when they start to see no cash value growing in this thing, or very little in relation to what they're putting into it, they lose the desire to keep putting money into it. It's really hard to get psyched about putting money into this thing when it's got a third of what they put into it and we're already 8 years into it. Like that's ridiculous. Moving back here to my policy, can you understand psychologically how much easier it is for me to make a $6,000 payment a year, knowing that I've already passed my break even, I've got $30,000 in there, more than what I've paid into it, and I'm getting a good return. I'm excited every time my anniversary rolls around and I can put more money into this policy because I am maxing it out every single year. So when it comes to the designs of policies that we do and why I design it the way I do, to minimize commission, minimize those expenses, and optimize for cash growth. It's not because I don't like to earn money. I don't like to earn a big commission. I would love to earn big commissions all day long, right? But the likelihood of success when you have a proper design policy with minimal expenses, the likelihood of success greatly increases. Not just because you're actually going to grow cash value better, but also psychologically, you're going to want to continue max funding this policy, which is the absolute best use of a cash value life insurance policy. You want to put in as much money as they will let you while still maintaining it as life insurance, meaning we're not going to surpass that MEC limit. The likelihood of success when we minimize our expenses, optimize for cash growth, the likelihood of success goes up because of performance and the emotional aspect of investing, even though we don't like to call these things investments, having to continually send money to something or somebody, the likelihood of you wanting to do that increases if you're seeing good returns, if you have access to your money, if you're getting all the other benefits from it. And it's the total opposite. If you're sending in thousands of dollars and you're not seeing the benefit from that. So hopefully this has been a little bit eye-opening for you. If you have any questions about what a policy design might look like for you, I do Zoom meetings with people all day long from across the country. We're licensed in 40 plus states to design and sell these high cash value designs that are properly designed. I always minimize the commission as much as possible, and we design these policies to be streamlined with as low of expenses as we can so that you can fund it at the level that you're trying to fund it at and have success. So schedule a meeting with me if you're interested, if you want to talk about it. If you have a policy like this and you want me to take a look at it, even if it's not like this, if you just have a policy, you want me to take a look at it, share my thoughts on it, I do that all the time with people as well. Now with this particular policy, we're back to that bad design policy. There's a 10-year surrender charge period. The expenses inside of it, because of the high commission design that this was, the big charges each year run out after 10 years. They're 8 years into this. It doesn't really make sense for them to get rid of this policy at this point because we're just about to the point where they're done paying the big fees. They've already paid for the high commission. There's no way to get around that. They've already paid for the high commission. They got 2 more years to finish that off. And it's about $4,000 each year is the expense that's going to drop off once they get done with that 10-year period. The surrender charge on this is about $10,000. So if they were to cancel this policy now because they're not happy with it and that it's not fun to add money into it, but if they were to cancel it now, they're going to pay $10,000 in surrender charges. Well, they've only got 2 more years of $4,000 before that charge comes off. I don't recommend that they get rid of this policy right now. We might need to look at reducing that death benefit if they don't need that much death benefit. But the amount of money they're putting into this is going to start getting a lot better 2 years from now compared to the expenses. So we're going to wait and see. We're going to let those surrender charges come down, and then we're going to reevaluate and take a look. Does it make sense to keep continuing on that policy? It doesn't necessarily make sense now that they've paid almost all of the big expenses in the policy. It doesn't make sense to get out of it right then, even though clearly those expenses have had a detrimental effect up until now. So it's just one of the things that we're going to think about when we're evaluating this. We don't always want to say, yeah, this is a bad design policy, let's get out of it right now. We got to compare to the alternatives. If we start a new policy, you're going to have, even though we're going to minimize those charges, they're fresh charges. And you're still going to have to repay the new commission. Even if it's a low one, you're still going to have to repay that new commission off over the next 10 plus years, depending on which carrier you get a policy with. So it doesn't necessarily make sense to start over with that when we're just about done with the expenses on this one. Yes, I would never design a policy like this. And had we caught this earlier on in the policy, it might have made sense to get out of it earlier. But now we're so close to the end of it. We're going to give it a little more time and we'll evaluate it once we can see what the expenses are going to actually look like once the recouping of commissions comes off of this thing. So I'm hopeful that somehow they'll be able to salvage a little bit of this thing and it won't be so bad moving forward. But they've already had to take the loss of, what, $70,000 plus in expenses. That was probably higher than they needed in those first 8 years. Really, really tough to see a policy sold like this. This is one of the reasons I put out videos like this. I know a lot of agents watch my channel. Please don't sell policies like this to people. These guys weren't trying to buy a death benefit. They actually thought that they were going to buy something that would give them a decent return. That was what was sold to them. So if somebody's coming to you and that's what they're trying to buy, don't sell them a policy like this, please. And if you're in the market for this stuff, please meet with me, get a second opinion, even if you've already gotten something from somebody else. Get a second opinion. I'm happy to take a look at it. Not necessarily so that I can sell you something. Oftentimes I'll meet with people and just show them what type of better design they can expect. And if they like working with the current person they're working with, they can do that and just get a better design. Oftentimes They might be working with a family member, so they actually want to work with that person, but that family member may not know how to design better policies. I'll educate them on how to do that, knowing that I'm not going to make a sale on that, but that's okay. I would much rather take a few minutes of my time, help make sure somebody else gets a better design policy so they don't buy crap like this, and then we're all better off. They'll be in a better position to tell a story that says, I got this great product. It was designed really well. I'm happy with it. It's performing. We made money in it. As opposed to, I bought this garbage here that's just been terrible. I put $90,000 in it. It's been 8 years. I've got $30,000 in cash value. I hate this thing. Don't ever buy one of those. Like, that's the narrative that comes from friends and family that buy policies like this. So let's avoid that. Let's design good policies. I appreciate you joining me for this. Hopefully you'll find it helpful. If you have any questions, put them in the comment section. I try to respond to every comment that I can. And of course, if you need to meet with me, there's links in the description. Let's get together and have a conversation. Hope you found value in today's video. If you'd like to find out more about IUL and the whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.